All right, everybody, welcome. I hope you all are doing well this morning. Didn't do a live stream last week. Too much craziness going on in the world. But also, I had to do a lot of updates for the monetary base stuff. Had to do a lot of calculations, update my own database a little bit, as well as some other side work. Just to feed my family. So it takes some time. Sometimes to refresh things, to get an update, and I just didn't have time to do a recording. But having said that, I just want to jump right into it and do a little compendium, a little update to what I provided yesterday. So let me go ahead and share my screen. Feel free to let me know if you have any questions at all in the comments. I am happy to address them. So here's the old monetary base. All right. Let's take off the top 5 percentage. You can clearly see dollar, euro, yuan, and yen. Top 4 currencies there. Let's take off even the pound sterling right there. And let's take off the rest of the world. All right. So you see the total. You see the top 4. Obviously, this is a Pareto distribution. Always has been for a long time. Or I should just say always has been. But we see here, and one of the things that I addressed yesterday, and I want to continue to try to pull a thread on for people to understand, this idea of Wittgenstein's ruler, that it's hard to, when you have so many different currencies, and remember there are 50 currencies in this data set, up to the black line, we have the top 50 currencies in the world. Even though you see here from 2021 year end, $30 trillion, and this was the peak. In fact, December 2021, based on exchange rates, the peak from the pandemic was 30.5 trillion. All the stimulus that was printed was 30.5 trillion in December 2021. And we follow that down till today, where they tried to normalize it. You have the SVB bank defaults and many other crypto bank defaults, some forced on the industry in early 2023. A lot of people buying bonds here, which was completely inapt because, of course, interest rates were at all-time low at this point right here. And then they rose, and when rising interest rates occur, bond prices fall. Nonetheless, a lot of pain all the way through here as war rages in Ukraine. Israel, Gaza, other places around the world, Sudan, of course. We get to December 2024, fourth quarter update for 2024, and we get to 25.5 trillion. Now, if you did a simple ratio, let me even take off everything but the dollar just so we see. Okay, so this is only the dollar. But we have the black line, so the dollar is in the green shaded area, 5.6 trillion. Okay, and you see it's been actually roughly flat. There, of course, has been other things happening in the Federal Reserve's balance sheet. They've had this reverse repo facility, which is basically base money for non-banks. I'm not going to get into that. That has been declining. Also, base money has been declining, but not actually huge compared to the rest of the world in dollar terms. In any event, we got the green shaded area here. That's the U.S. dollar monetary base. Okay. Then you see this black line really falls. All right. 30.5 trillion, end of 2021, down to 25.5 trillion. All right. So $5 trillion drop in 3 years. $5 trillion drop. And as I pointed out in the report, what does $5 trillion drop over 3 years, what does it represent? Nearly 17%, 16.5%, something like this. Okay, so it's a 16.5% drop in the monetary base. But, and this is the key thing, though it's a 16.5% drop in dollar terms, does it mean that every central bank was, in fact, cutting their money supply by 16.5%? You can imagine the way that I formulate this question The answer is no. Okay, the answer is no. The actual drop of monetary inflation on a weighted average basis for the entire world was something like 3%. Okay, and I don't actually have it on this chart, but what you can see here, these are the these peaks. Okay, let's take off the all-time. This is the line. These peaks are trailing 12-month moves. Okay, so we see here, obviously, again, same thing, $30 trillion here, December 2021. At a trailing 12-month basis, at this point, we're at 13%, which is actually right around the average. Is right around the all-time average, all-time number. We've fallen till now. If you look in the tooltip here, we're at a 3% decline, weighted average. Okay, but that's only a trailing 12-month figure. If I did a 3-year gross figure, it's actually the same. It's actually even less, 2.4%. So this is the, in my opinion, very interesting mirage that occurs in money, central bank money around the world, is that even when the dollar values fall tremendously, they're pretty close to flat, pretty close to still printing, which shows tremendous seigniorage for the dollar. That is the United States dollar, not for, the euro or the yen or the yuan. It's for the dollar, because really what you're seeing when you see this, managed or mismanaged fall from 30 trillion to 25.5 trillion, it's not a coordinated effort for every central bank to slowly rein in their balance sheets. Although they did it a little bit, but on balance, on net, it was only 3% gross. All right, and you see in the last year it was also 3%. It's even less than 3% growth. You can't see that though in this picture. In this picture, you see a $5 trillion coming down. That's not what happened. That's not what happened. On a weighted average basis, it's not 16, 17% drop. It's only about 3% drop in the monetary base. And now, of course, the question is going to be, how long can they even continue this? Because yes, we are at historical lows of non-money printing. You can just see it right here in this chart. All right. These bars are trailing 12-month weighted average figures. All right. So we go in the 70s, your weighted average for all central banks, 12, 14, 13% per year. Just rolling. Big bump here in Y2K. Everybody's scared. Gary North, the Holocaust denier, buried a tractor. Sorry, I just had to put these little jabs in some of these crazy right-wingers that, a lot of these fans support Russia today, which I find is preposterous, but I can't let this get in the way too much of my non-biased monetary and economic reporting. At least I will try. A lot of people thought the world was going to end here. Y2K. There's a lot of money printing. We had December 1999, 25.7%. That was a record in the modern era. It was a record. Until the GFC, until the global financial crisis, until Norwegians were buying mortgage-backed securities, all the rest. You get up to a record, and it actually still is a record even with COVID, of 33.5%. Yeah, 33.5% was the record. 33.5% on a trailing 12-month basis. Massive money printing. Massive money printing. All right. So again, the monetary base, this green thing that I'm showing, this is the printing press. Nothing else. Why do I dedicate so much time to this when I talk about Bitcoin? Because this is the only money supply that is analogous to Bitcoin. This is the only money supply that's analogous to Bitcoin. We can talk all we want about M1, M2, M3. United States doesn't even publish M3 anymore. I do have a revised M3 that I can at least get quarterly to you, and we've talked about that. You put all those global monetary supplies, they're called broader money supplies together. Most people use M2. Again, it should be M3. You can get over $100 trillion at this point, over $100 trillion. That's not analogous to Bitcoin. This is the analogous money supply to Bitcoin. Okay, it's a central bank money. And again, to finish the thought that I've started this show with, there's no lower time in money printing than right now, than the last 3 years. Okay, I'm not showing negatives here in money print because it just kind of distracts from the rest of the chart. But let's read them in the tooltip. Negative 0.4%, 8, negative 2%, negative 2.3, negative 1.4, negative 1.9. So some less levels of decline, some more levels of decline in the money supply. And again, this is the brass tacks number that you're seeing in the black bars, the weighted average. And then even some on net money printing by the end of last year, 2 years ago, December 2023, on net money printing, and then down again to where we've done a 3% decline. So I'm just trying to reiterate, it's a mirage. It's a mirage to say that this loss in $5 trillion in value was a reduction in $5 trillion in money printing. It was not. It was not. It is true that the big central banks around the world, the dollar, the euro, the yuan, and the yen, in the last year for sure, but not necessarily even in the last 3 years, they reduced their money supplies, but not actually by a huge amount. What you are actually seeing here is a reduction in those currencies' exchange rate or purchasing power versus the dollar. So it shows you how strong the dollar is. Put the Great British Pound here, the formerly Great British Pound. Bitcoin passed it about a year ago, February 2024. Bitcoin passed $1 trillion in value for the first time. Not for the first time, but for the first time larger than the Great British Pound. Sterling. All right. And as of now, Bitcoin is still bigger than that. Bitcoin is 1.8 trillion, even though it's kind of crashing at the moment. Still $1.8 trillion. So that is what we see. It's very interesting. All right. And then we have the rest of the world. Fills it out here. How much is it in total? Only about $5 trillion. The rest of the world. And look at that. This is another important point. Look at the rest of the world figure in February 2022. A little over $5 trillion. Now, a little under $5 trillion. Okay. So really what you see when you see this drop in the, the value of these currencies, you're really seeing a drop in the value of the major currencies, of the euro, the yen, the yuan, and the former Great British Pound sterling. All right. Sterling was 1.4 trillion in December 2021, now $1 trillion. That hurts these economies. I mean, this is where dollar hegemony is such a boon to Americans. They don't even know it. They don't even know how blessed they are to have that world's reserve currency. But we'll see how long it lasts, right? I mean, we're moving into a multipolar world, as they say. Russia continues to be maximalist in its goals. China will as well. India is coming onto the stage. India is trading with Switzerland as the next largest currency, by the way, after the pound sterling. But still smaller than the pound sterling on this chart, which is remarkable when you think how India and China trade as the largest country in the world. So the point is dollar hegemony remains supreme no matter what you kind of hear. People still want to hold the dollar. And that really affects the numbers when we think about, how the money supply grows or not. So even though the overall point, even though you see this $5 trillion drop in the last 3 years of the global money supply, what is actually happening is only about a 3% drop, which is amazing. All right. More of this dollar crashing is those currencies becoming weaker. All right, and you just have to tear through the numbers to come to that conclusion. That's what I show in the report. That's what I'm showing here. Trailing 12-month change is 3%. And that in itself, by the way, is extreme. I'm not saying that's good or bad. I'm just saying even that slight decline in the overall balance sheet of the world, of all central bank money, is a record. All right, only here in December 2000, when we were rounded to negative 0.0, slightly under zero, that means, were we negative in a major like way of decline. And that was only because, of course, Y2K the year before it. We had to unwind that a little bit. But by and large, and I'll put the line up, world central banks print at 12.7% per year compounded. Blended weighted average. So my question would be, how much longer can this go on? Because pain, you just only get pain, all right? Putting all the political issues aside with how the government in the United States may choose to spend less fiscally, it is the right move to spend less fiscally to deal with the huge debts that the United States has, the huge deficits that they continue to add on to the debt every year. Again, the debt is just a compilation of all prior years' deficits. All right. So, of course, the solution is less government spending to these problems. You have to wonder the political will, though, of how much longer they can go, because monetarily, this is record belt tightening. It's a record. 3 years. All right. If you don't count this little blip up in 2023, we're at 3 years of record tightening, which again is not that low. It's not 16% over 3 years. It's more like 3. Read the report to see more there. It's even under 3. All right. If you balanced it. But from here, let's say once we go below the average, you see what I'm pointing to right here. Okay. January 2022. We're now in almost, basically January, February 2025, March 2025. That's 3 years. That's 3 years of being well under the average. The only other time we had that in the history of modern economics was here before COVID. How long did that last? 2 years. 2 years. From basically 2018, all right, to 2020. Little over 2 years. Little over 2 years. And then, of course, we all know what happened in 2020. So they've tried this before. Remember, this gap here is trying to solve the problem of this. All right? It's trying to unwind this. It's trying to normalize this. It's trying to counterbalance the excesses of this. That's what this is. And then, of course, we had this. So we have more excess. In a nutshell, that's what's happening. That's why I much prefer to look at supplies and growths, or growth or decline in supplies compared to interest rates. In fact, it is true for sure. Interest rates are the most powerful signal in the economy. Those as well are controlled by the central bank, which is a fairly communist thing to do, but that's how modern economics works at this point. Even though interest rates are a huge signal throughout the economy, the brass tacks of how those interest rates are manipulated is here. It's in this picture. And, one has to wonder globally how much longer we can take the pain. It's been 3 years. We know that the leader of America, I don't want to say the leader of the free world, but the leader of America is begging for lower interest rates. More money printing. It is a record low money growth, record negative money growth. Although, again, to be clear, it's not actually as low as it might seem, right? It seems like it could be 16% drop. If you look from here to here, $5 trillion drop, it's not exactly that. What's happening is a combination of both dollar dollar hegemony, and tightening of balance sheets. But that tightening of balance sheets is way less than you think. So I hope that helps sort of set the table for what is to come. Of course, I don't have a crystal ball. I just look at the numbers and try to project. All indications show that my Q1 update for 2025 will also be pretty low. Okay. Even with a slight cut that the United States has had over the last few months, the balance sheet was even going down globally, or not globally, but in the United States, in the Federal Reserve. So all indications would be that the Q3 numbers would still be pretty low. The question is how much longer the world can take this pain before they start printing again. .7% per year is a pretty constant number. I could show how this number grows or falls over time. It's not much of a difference, actually. I just like showing the straight line to keep things simple, but I could show how it evolved. This little period in the 70s pulled it up. This little period, then this period in the 80s pulls it down, up. You know how it goes. It's just it's just math. But I like showing this sort of straight line, so you kind of see that this is the brass tacks figure from my research. All right, let's look at it again now. I have this figure on this monetary base on log scale. Let's look at it now. This is just, well, let me take it off log scale. This is the monetary base on linear scale, log, linear, log. Let's take off these percentiles. Okay, so this is actually the total. This is the same chart, same numbers as here. Same thing. Okay, just have it on log. We're going up to, actually I have this one grow out for various reasons. It's just an estimate, doesn't matter. Oops, sorry, this is zoomed in. I don't have it growing out. December 2024. December 2024. 25.5 trillion. All right, this is the same figure as this chart, same stuff, just on log scale. Now let's put in a regression trend line. Now this is on dollar values. So you almost need to forget everything I said about these figures being the native important numbers. Let's look at how things grow dollar-wise to see how this dollar hegemony might continue. So let's put a exponential trend line through. That's the best fitting for most markets in the world, except for Bitcoin. Nice straight line through the money supply. All right. Let's look at where we are today versus the trend. This is another wild projection. It shows you how low we in fact are historically on the money print. Extremely low. All right. How low? How low? Well, let's put up a 2.5%. Sorry, I shouldn't have done that. Let's do a 97.5 percentile, which this is like, rare air to the upside. 50 trillion, nowhere near that, right? Rare air to the downside, we are under it. Rare air to the downside would be $27.4 trillion at $25.5 trillion monetary base. We are below that. So extremely low levels of money print at the moment. And it's been that way for 3 years. With this, I have all these charts in the update, by the way. Of course, they're static charts. You don't have the nice slider that I have here. I just can't technologically do that yet. Make something nice and interactive like that. But what you have here, which I like this presentation better now, is I'm showing you the evolving percentile bands, but the all-time trend. So the all-time trend is here, all right, obviously. But even exponential trends, every trend will go up or down a little bit as new data is added, right? So let's go back to the 70s. We were a little bit hot even compared to the all-time trend. Okay, so the all-time, this is taking all the way data up until 2024 December. We were ahead of pace of this current pace, right, in of the all-time pace in the 70s. A lot of money printing in the 70s. And then from the 80s, the whole great moderation period, we cooled it down. So here's the question. Is this what we see again? Right? Remember what happened during the great moderation period of 1980 to 2000 is you saw gold stay flat and go down, in fact, $850 to $200 an ounce. Will the gold price do that? And then, of course, we had, excess low interest rates, mortgage-backed securities, all the financial shenanigans. And we brought this trend line back up to, its levels, which actually was more in line with, again, the 70s, than the 80s and 90s. And you can see that this sort of all-time trend really matches from about here. You can see those red lines that in the future, they're just projected out on the trend, but in the past, they kind of evolve. But still, you can see those red lines, the bounds are pretty close from about 2014. So that was the level of money print that we, sort of established as a firm trend in the last 10, 15 years, based on the fact that those red lines are pretty not equidistant, but pretty constant. That's the word I'm looking for, constant around the black line, as opposed to, say, here, where the trend was way under for 20 years. It's under the black line, as opposed to here, where it was even over the black line. We've been pretty constant, all right, over the last 10, 15 years. Now we're under it again. That's a very interesting sign to me. So the question would be, do we think that the world is going to go into some sort of a overall, it's not a deflationary environment. You could maybe call it disinflationary, which means a lower rate of money growth than before. Not talking about prices at all. I'm just talking about money growth. Maybe the world will move into that. All right, maybe we're going to move into more like a period like this. Or maybe it's just a quick kiss of these lower levels, and soon we'll start cranking up the printing presses again. Hard to make a prediction there. Hard to make a prediction. The post-Bretton Woods, the post-gold world order is not that rich in data. It's only here. This is the only chart you'll see anywhere that has this level of detail of the monetary base, but also, this is something that is basically detached from gold. Currencies throughout humanity have always had some attachment to gold or silver. In the United States' case, it was silver at the beginning of the Republic. So it's not that much data, really. A few thousand years of sort of civilizational humanity. We don't have that much data. We only have 60 years of data, 65 years of data to go by. So, on the one hand, I could say your guess is as good as mine. I'm glad we have something like Bitcoin to be an escape hatch. But there's going to be a lot of pain here, a lot of pain. Remember, one of the good things, quote unquote good things, was that here in the overheated money printing phase of the 70s, the reason that they were able to, how can I say this? The reason that they were able to bring down the relative rate of money printing was actually because they pricked the gold bubble and they took interest rates very high. Not just Volcker, but many of the central banks took interest rates to 20% by the end of the 70s. All right, and once you have a very high base of interest rates, things can only get better for bonds, for government bonds. So as those bonds get lower and lower in price, lower and lower in interest rate, all right, in demanded yield, the price can get higher and higher. Okay, so that's a leverage that you don't see here because this is the monetary base. You don't see, the relative increase of global debts and so on and so forth. But debts were able to get higher from 80 to 2000. No one really would argue the case that could happen here today, that global debts could get higher or higher at a pace that would outstrip the trend because they're already extremely high. I can show a U.S. debt figure or Eurozone debt figure at some point, and I will. But first things first. First things first. This is just the money supply, and that's what I wanted to show. This is the this is the main takeaway from the 2024 update as they continue to tighten. And if you look at this at log scale, you look at this with the 2.5 percentile range, bounded range here. We're below the multiple. Below the multiple should be something like 0.7x. All right. I mean, this is based on multiples around the trend. So if you look at the 2.5, you can do it. I won't even do the math, but I'm pretty sure it is 27 trillion. Yeah, I mean it's 27 trillion. Let me tell you exactly what I'm talking about here. 27 trillion is the red number. See the red in the tooltip? 27 trillion, 27.4 trillion. The trend itself is 34. So that is a 0.7x multiple. Or if you do percentiles on those multiples, 2.5% of the observations throughout history, back to the 60s, achieved that multiple. Very, very rare. Very, very rare. If I had to guess, based on how past crises have been solved, and of course black swan, anything can happen with a black swan. But if I had to guess, we're going to switch this trend in the relative short order, maybe in the next year, and go back up. Because in itself, population grows, although it's not growing that fast anymore. But in it, prima facie, we still grow, and the biggest way for governments to paper over any sort of issues is just to print more money. And that's what you're looking at here. This is the global printing press. That's if I had to guess. Now, anything could happen. I guess they could try to, for some reason, really push the money print down further or keep it lower longer. But, indications from the leaders don't seem to be that way. Of course, we need to watch the central banks. I think Powell from the Federal Reserve, he wants to be kind of heroic in the Volcker sense of the word, cutting off all the excess inflation that happened during the pandemic and before. But we will have to see. Time will tell. In the meantime, that is the big picture. It's been 3 years at very, very low rates of monetary growth, even negative growth. About negative 3% weighted average over the last 12 months. That's it for this video. Thank you guys for watching. Take care.